Let's get to Mike McKee right now. You've seen the reaction in the markets. Let's get a little bit more on what the Fed said and did. He is a Bloomberg economics editor. Mike, what have we got?
Well, Alan Blinder perhaps put it the best. They changed as little as they could in the statement and produced about as boring a statement as they could. Fed officials couldn't avoid taking note of the improved economic data we've seen lately, though, saying economic activity has picked up following its severe downturn. There was no change in their assessment for price pressures, though. The committee expects that inflation will remain subdued for some time.
What the Fed is doing is it's got to maneuver the financial system through this crisis. It's vulnerable. And in terms of balancing risks, the risk of a deflation or a resumption of the financial collapse is a lot worse than the risk of inflation on the other side.
Now, one interesting change in their outlook. In August, they said their policies would contribute to a gradual resumption of sustainable economic growth. Today, they expect a strengthening of economic growth and a gradual return to higher levels of resource utilization. Economists can puzzle over that and debate its meaning until the next meeting on November 4th. Meanwhile, the big announcement was, as you've heard, the stretching out of their mortgage-backed securities buys. Instead of ending it in December, it will gradually taper off in the first quarter of next year. There is still about $460 billion left in the program. It would have been hard to buy them all in the time left anyway. Stretching it out will also give the market more time to heal. Right now, the Fed is the major buyer. As Torsten Slok over at Deutsche Bank told me, the MBS market can't stand on its own right now, and that's kind of what the Fed's looking at. Can the economy stand on its own? Today's statement suggests no.
All right, got it, Mike. Thank you.